I hate paying taxes, said nearly every retiree I've ever met with. Now, there's a multitude of reasons for this, ranging from not agreeing with how your tax dollars are spent, or simply wanting to keep more money in your pocket so you can decide where it goes. And I'm with you. I don't want to have to pay more tax than I have to throughout my life either. But we have to be careful. In our quest to pay as little tax as possible, legally of course, we can't lose sight of the long-term picture. Let's say that you're 65 years old and you're receiving your CPP and old age security. You also have $700,000 in your RRSPs, $250,000 in a non-registered account, and $120,000 in your tax-free savings account. Now, if you have more or less than this saved up for retirement, that's okay because the principles remain the same. Let's also say that you're pretty frugal and that you only need $3,500 per month to have the lifestyle that you desire in retirement. So after receiving your CPP and OAS, you would make up the difference from your retirement portfolio. So if the goal is to pay as little as taxes as possible, it would make sense to draw on your TFSA first because anything withdrawn would not be considered taxable income. Another benefit of keeping your income low is that you may qualify for additional government benefits like GIS. So let's map this out to see the long-term impacts of this strategy. As you can see, your tax bill is very close to zero for the first few years of your retirement. It does jump up in 2030 because at that point, you'll be forced to make the mandated minimum withdrawals from your RIF. So by following this strategy, you'll have paid just over $278,000 in taxes throughout your retirement. However, is there a strategy that we can implement that will lead to less taxes being paid? Instead of drawing on our TFSAs first, let's say that we started drawing on our RSPs pretty aggressively and that we wanted to target a taxable income of $71,000 per year. By implementing this strategy, we can see that we're paying a lot more taxes upfront, but there are a bit of savings once we hit 2030. So does this strategy lead to less taxes being paid throughout your retirement? Well, no, actually, you end up paying taxes of just over $362,000. So if the second strategy leads to more taxes being paid, why would we ever want to implement it? Let's take a closer look at your retirement accounts over time. So in scenario 1, we're drawing on the TFSAs first, and then once you're 72, we are only withdrawing the minimum amount from the RIF every year because again, the intent is to keep your tax bill as low as possible. The problem with this strategy is when we reach the plan's end, there's still quite a bit of money left in your RIF, and that entire amount gets added to your final tax return, which could lead to a substantial tax bill. In scenario 2, we're being a lot more aggressive with our registered withdrawals, and there's actually no more money left in your RIF by the time you reach the plan's end. If we include the year of death in our tax calculation, scenario 1 looks way worse now with a tax bill of over $400,000. So in total, had we followed scenario 1 throughout your retirement, you would have paid total taxes of just under $683,000. In scenario 2, there is only a small tax bill that needs to be paid at the plan's end. So in total, this scenario would have led to a tax bill of $394,000 throughout the plan. So that's a difference of $288,000 in taxes compared to the first scenario that we looked at. So yes, scenario 1 does lead to less taxes being paid while you're alive, but let's not lose track of the long-term picture because scenario 2 is a lot more effective. If you have a large RSP and you're not sure how to draw it down tax efficiently, then check out this video.